The U.S. Congress has recently passed several key bills aimed at regulating the cryptocurrency industry, marking a significant step towards providing clarity and stability for digital assets. Among these is the Guiding and Establishing National Innovation for U.S. Stablecoins (GENIUS) Act, which establishes a regulatory framework for stablecoins, digital assets pegged to stable values like the U.S. dollar. This act sets guidelines for issuers and protections for holders, potentially boosting investor confidence and market stability. The GENIUS Act has already passed the Senate and is awaiting approval from President Donald Trump. Additionally, the House approved the Digital Asset Market Clarity Act of 2025, which delineates the regulatory responsibilities between the Commodity Futures Trading Commission, CFTC, and the Securities and Exchange Commission, SEC. This legislation classifies digital assets into securities, commodities, and stablecoins, aiming to reduce regulatory ambiguity and foster a more structured oversight of the crypto market. Another significant piece of legislation, the Anti-Central Bank Digital Currency (CBDC) Act, was also passed. This act seeks to prevent the Federal Reserve from issuing a CBDC, addressing concerns about potential government overreach and financial surveillance. These legislative efforts, supported by bipartisan backing, line with the broader ambition of positioning the U.S. as a global leader in the cryptocurrency space, potentially attracting more institutional investors and encouraging innovation within the sector. In other economic news, Union Pacific and Norfolk Southern are in discussions for a merger that could create the largest transcontinental railroad in North America, though it faces regulatory scrutiny. Meanwhile, Netflix continues to demonstrate strong performance with over 300 million subscribers, maintaining its market dominance amid growing competition. Lastly, U.S. retail sales showed resilience with a 0.6% increase in June, indicating consumer spending strength despite economic uncertainties.
The S&P 500 reached a new record high, closing at 6,304.69, driven by stronger-than-expected earnings from major companies and positive economic data. Notable contributors to the index's rise included PepsiCo, United Airlines, Nvidia, and Microsoft, with PepsiCo and United Airlines experiencing significant stock gains of 7.6% and 4.8% respectively. Of the approximately 50 companies that reported second-quarter earnings, 88% exceeded Wall Street's expectations, according to FactSet. The Labor Department reported a decline in weekly jobless claims to 221,000, and retail sales saw a 0.6% increase in June, both surpassing forecasts. Nvidia reached a new high, reinforcing its position as the world's most valuable company with a market cap exceeding $4.2 trillion. However, inflation rose by 2.7% in June, slightly above expectations, influenced by tariffs from the Trump administration, raising concerns among investors about potential political influences on monetary policy and the future of Federal Reserve Chair Jerome Powell. Globally, Wall Street's positive momentum influenced the Australian Securities Exchange, ASX, which is set to rise with the ASX 200 index climbing 0.7% to 8,696.5 points. This was driven by strong performances in the healthcare and materials sectors, particularly due to BHP's impressive annual production figures for copper and iron ore, despite a $2 billion cost overrun and delays at its Jansen Potash project in Canada. On Wall Street, the tech sector saw significant gains, with Taiwan Semiconductor Manufacturing Company reporting a 61% increase in net income due to AI sector demand. Meanwhile, PepsiCo's stock rose 7.5% following strong revenue and profit figures, despite cost pressures from tariffs. Conversely, Abbott Laboratories faced an 8.5% decline due to a revised revenue growth forecast for 2025. The robust economic data, including retail spending and manufacturing growth, could influence the Federal Reserve's interest rate decisions as inflation and tariffs remain key concerns.
Bitcoin Standard Treasury Co. BSTR is set to go public through a merger with Cantor Equity Partners CEPO, a special-purpose acquisition company, SPAC, affiliated with Cantor Fitzgerald. This move will position BSTR as a significant player in the public Bitcoin treasury space, launching with 30,021 Bitcoins on its balance sheet, making it the fourth largest holder among public companies. The The transaction, which has received unanimous approval from both companies' boards, is expected to close in the fourth quarter, pending shareholder and regulatory approvals. The company will utilize the proceeds to acquire additional Bitcoin and develop Bitcoin-native capital markets products and advisory services. The leadership team of BSTR includes CEO Adam Back, known for inventing Hashcash and co-founding Blockstream, and Chief Investment Officer Sean Bill, a seasoned fintech and hedge fund investor. The strategic aim of BSTR is to maximize Bitcoin ownership per share and promote real-world Bitcoin adoption. Aligning with the broader trend of integrating cryptocurrency into traditional finance, this transaction highlights the growing trend of public companies adopting Bitcoin treasury strategies, as evidenced by recent movements such as Anthony Pompliano's ProCap BTC and the formation of 21 Capital by Cantor Fitzgerald, Tether Holdings, and SoftBank Group. These developments underscore a significant shift towards incorporating Bitcoin into mainstream financial strategies, potentially influencing market sentiment and encouraging further institutional adoption of cryptocurrencies.
Abbott Laboratories experienced a significant stock decline following its recent earnings report, despite reporting better-than-expected top and bottom-line results for the second quarter. CEO Robert Ford attributed the market reaction to an overreaction, emphasizing that the company's fundamentals remain solid. The primary driver of investor disappointment was Abbott's decision to tighten its full-year earnings guidance. The company's shares fell over 8% as a result. Abbott, a major player in the healthcare sector with products ranging from medical devices to nutritional products, is also dealing with ongoing lawsuits related to its infant formula. In the earnings call, Ford highlighted the underperformance of Abbott's diagnostics business in China, contrasting it with strong performance in other regions such as the U.S., Europe, and Latin America. He noted that while the company is working towards a recovery in China, it might take a few more quarters. Meanwhile, Abbott's medical devices segment continues to show robust growth, driven by innovations in diabetes and heart treatment devices. Additionally, the company's generic pharmaceutical business is performing well in emerging markets, benefiting from favorable demographics such as a growing middle class and aging populations. Overall, while facing challenges in specific areas, Abbott remains optimistic about its diverse business portfolio.
Hims & Hers Health Inc., NYSEHIMS, is facing securities class action lawsuits following Novo Nordisk's termination of their collaboration over allegations of deceptive marketing practices. The lawsuits, filed on June 25, 2025, target Hims & Hers and certain executives, representing investors who purchased the company's securities between April 29, 2025 and June 23, 2025. Novo Nordisk, the manufacturer of the FDA-approved weight loss drug Wegovy, accused Hims & Hers of selling unauthorized and potentially unsafe versions of Wegovy under the guise of personalization, contravening U.S. regulations on drug compounding. This announcement led to a significant 30% drop in Hims & Hers stock price. The legal actions claim that Hims & Hers misled investors about its regulatory compliance and the sustainability of its GLP-1 drug revenue stream. The company had previously assured investors of its compliance with FDA regulations and the benefits of its collaboration with Novo Nordisk. However, Novo Nordisk's decision to end the partnership highlights potential risks and misconduct in Hims & Hers business practices. The ongoing investigation by Hagens Berman, a national shareholders' rights firm, encourages affected investors and individuals with relevant information to come forward, emphasizing the potential for significant financial recovery through the SEC whistleblower program. This situation underscores the critical importance of corporate transparency and regulatory compliance in maintaining investor trust and market stability.
The U.S. government is accelerating its efforts to integrate artificial intelligence (AI) more deeply into the national economy, with President Donald Trump hosting a summit in Pittsburgh alongside executives from leading tech and energy companies, including Meta, Microsoft, Alphabet, and ExxonMobil. The summit, held at Carnegie Mellon University, focused on positioning the U.S. as a leader in AI amid intense competition with China. An estimated $90 billion is set to be invested in AI and energy within Pennsylvania, marking a significant commitment to advancing technological capabilities and economic growth in the region. Among the key stocks that hedge funds are currently monitoring, International Business Machines Corporation, NYSE, IBM, and CrowdStrike Holdings, Inc., NASDAQ CRWD stand out. IBM, recognized for its AI consulting and software, received a reaffirmed buy rating from Stifel analyst David Grossman, with a price target increase to $310, reflecting optimism about its stable growth potential. Meanwhile, CrowdStrike has expanded its collaboration with Amazon Web Services to enhance AI adoption in cybersecurity, highlighting the growing importance of secure AI operations. These developments underscore the strategic moves by companies to capitalize on AI advancements, which are expected to drive future growth and innovation across industries.
The article discusses the investment strategy of acquiring beaten-down stocks, specifically those that have experienced significant declines in value but hold potential for recovery. J.P. Morgan Research anticipates that the S&P 500 could reach 6,000 by the end of 2025, driven by double-digit earnings growth, with an expected EPS of $290 in 2026, representing a 12% year-over-year increase. This optimistic outlook is tempered by concerns over global trade policies potentially slowing economic growth and shifting inflation pressures toward the U.S. J.P. Morgan also notes a normalization in global equity volatility post-April 2025 tariff shocks, with a median VIX of 19 year-to-date, and anticipates further declines in U.S. market volatility. The article highlights Simulations Plus, Inc., NASDAQ, SLP as one of the top beaten-down stocks, with a 56.5% decline over 6 months, despite a downgrade from KeyBank due to challenges in the biopharma market. The company reported a 10% increase in Q3 2025 revenue. The firm has undergone a strategic reorganization to streamline operations and focus on growth opportunities. Hedge funds have shown interest in SLP, suggesting potential for market outperformance by emulating top hedge fund picks. The broader investment strategy emphasizes selecting stocks popular among hedge funds, which historically has led to significant market outperformance.
Rocket Pharmaceuticals, NASDAQ, RCKT, is facing significant turmoil following the U.S. Food and Drug Administration's FDA decision to place a clinical hold on its Phase 2 trial of RPA-501, a gene therapy aimed at treating Danon disease. This rare genetic disorder affects multiple organs and can lead to early death due to heart complications. The announcement, made on May 27, 2025, led to a dramatic 62% drop in Rocket's stock price in a single day. The FDA's action was prompted by a serious adverse event, that resulted in a patient's death during the trial, raising concerns about the safety and efficacy of the treatment. The situation has escalated into a legal battle as a securities class action lawsuit has been filed against Rocket Pharmaceuticals. The lawsuit, covering investors who purchased shares between February 27 and May 26, 2025, alleges that the company misled investors by not disclosing significant changes to the trial protocol, including the introduction of a novel immunomodulatory agent. Plaintiffs claim these undisclosed risks contributed to an artificially inflated stock price, which plummeted once the information became public. The deadline for lead plaintiffs to join the lawsuit is August 11, 2025. This development highlights the potential financial and reputational risks biotech companies face when clinical trials encounter unforeseen complications.
Omnicom Group Inc. and Interpublic Group have received clearance from the Australian Competition and Consumer Commission, ACCC, for Omnicom's proposed acquisition of Interpublic. This approval marks a significant milestone, as it is the 14th out of the 18 antitrust approvals necessary for the transaction to proceed. The merger, which is expected to be finalized in the latter half of 2025, aims to revolutionize the marketing industry by combining the strengths of both companies to deliver enhanced outcomes for clients and substantial value for shareholders. The merger of these two global marketing giants is set to reshape the competitive landscape, with Omnicom and Interpublic collectively servicing over 5,000 clients across more than 70 countries. The integration is anticipated to leverage their combined expertise in data-driven marketing solutions, strategic media planning, and innovative creative services. As the transaction progresses toward completion, Market analysts are closely monitoring its potential to influence industry standards and client relationships, as well as its impact on the stock performance of both companies.
Federal Reserve Chairman Jerome Powell has responded to the White House's inquiries regarding the budget overruns in the renovation of the Fed's headquarters in Washington, D.C. The questions, posed by White House Director Russell Vought, were part of President Donald Trump's broader campaign to pressure Powell to step down, primarily due to Powell's refusal to lower interest rates. Powell provided a detailed explanation for the cost overruns and denied allegations of extravagant additions, emphasizing the Fed's commitment to transparency by directing Vought to a dedicated page on the Fed's website. The tension between the White House and the Federal Reserve underscores the ongoing political pressure exerted on the central bank, potentially impacting market sentiment and investor confidence. This situation is further complicated by Vaught's assertion that Powell mismanaged the Fed and misled Congress about the renovation project, which could lead to further scrutiny and possible investigations. The broader market implications hinge on how this political pressure may influence future Fed policy decisions, particularly regarding interest rates, which are crucial for economic growth and stability.